Welcome back to the Noob Selling Options channel. You guys, I'm incredibly excited for today's explainer because we are tracking a massive, unprecedented market event that is literally barreling right toward us. We're talking about an impending structural shock that is going to heavily impact the semiconductor stocks you've been watching all year. Specifically, I'm looking at the massive runners like Micron and SanDisk. But here is the fascinating part. Actually, this is absolutely crucial to understand. This impending drop, it won't have anything to do with microchip demand, bad earnings, or broken supply chains. Nope. It is entirely about the math of the market. Let's get right into the data. $1.75 trillion. That is the staggering targeted valuation for the highly anticipated SpaceX IPO, which is setting its sights on a historic June 12th listing. To put that into perspective, at this valuation, SpaceX isn't just going public, it is demanding an immediate seat in the top 10 most valuable companies in the United States. And to do that, it aims to suck up to $86 billion in physical, raw cash from the market. When an absolute juggernaut of this scale demands a seat at the table, it creates a literal liquidity black hole.
Okay, let's dive into this. Here's a quick roadmap of how we'll break down the IPO's impact today. We'll cover the liquidity black hole, the institutional ATM, base case bottoms, refilling the void, and finally, year-end peak targets.
All right, Section 1, the liquidity black hole.
A lot of retail investors just assume that when a massive company goes public, new money kind of magically appears in the market to buy it. But institutional reality is completely different. Let's walk through the mechanics of what we call the denominator effect. Step 1, SpaceX goes public at that massive valuation. Step 2, large pension funds and passive index trackers are structurally mandated to buy into megacap debuts once they hit major indices. They literally have to buy billions of dollars of SpaceX shares just to avoid tracking errors. But they don't have infinite cash. So step 3, where does that money come from? Well, it gets carved directly out of existing core holdings. Fund managers are forced to sell their highly appreciated winning stocks to fund this new purchase. It's essentially a story of forced asset rotation.
Moving on to Section 2, the institutional ATM machine.
So if fund managers are forced to sell to raise billions in cash, who takes the hit? Historically, it's the biggest winners of the year that face the brunt of this liquidity squeeze. This quote from our research sums it up perfectly. It says, the biggest risk to the semiconductor sector right now isn't necessarily a sudden drop in microchip demand. It's a sudden shortage of investment capital. I really want you to keep this in mind. The business fundamentals for these chip makers, they aren't breaking. Data center buildouts certainly aren't stopping. The math is simply changing because there's a capital vacuum pulling money right out of the room.
And this brilliantly illustrates the concept. When a mega fund needs $500 million in liquidity by next Tuesday, they don't sell their illiquid, beaten-down small caps. They sell deep, highly liquid mega caps where they can exit massive blocks without totally destroying the price. Companies like Broadcom, Nvidia, Micron, and SanDisk have immense built-in capital gains and massive daily trading volume. Because crowded institutional trades like these memory semiconductor stocks have run up so high, they get treated like an ATM. They get harvested for cash first.
Which brings us to Section 3, base case bottoms.
Assuming a pure liquidity drain scenario, we are going to look at the specific retracement data for our two key memory players. First, we have to understand the fundamental difference in what they actually do. Micron is the premium play right now because of its dominance in HBM3E. That's the ultra-fast, high-bandwidth memory stacked directly onto NVIDIA's AI graphics cards. On the other side, following its spin-off, SanDisk is a pure play for NAND flash storage, specifically enterprise SSDs. So both are deeply tied to the semiconductor cycle for sure, but they have very different vulnerabilities when this liquidity black hole opens up.
Let me guide you through this downside profile matrix, because it becomes really clear just how vulnerable they are. Micron's vulnerability to a liquidity drain is high, purely because of its deep institutional ownership. It's an easy target for profit harvesting. But look at SanDisk. Its vulnerability to the liquidity black hole is extreme. SanDisk has been a high beta multi-bagger. It has gone completely parabolic. When broad market risk-off sentiment hits, high-growth, high-beta names like this face extreme vulnerability to algorithmic momentum reversals and margin call trimmings.
So the crucial point is, where do they bottom out? Let's look at the math from Micron. Our pure liquidity bottom is projected to drop between $680 and $740. Here's the pure valuation math. The stock isn't crashing because earnings are bad. In fact, its strong trailing EPS of roughly $21.18 stays completely intact. Instead, its trailing PE multiple simply compresses by about 20 to 25%, down to a normalized 32x to 35x, as easy money exits. Technically, this $680 to $740 range represents a standard 25 to 30% drawdown from its peak, landing right on a massive consolidation shelf. It's a very strong base case bottom.
Now for SanDisk. The pure liquidity bottom drops to a range of $1,100 to $1,200. Because it had a hyper-speculative run-up, the multiple compression takes its premium peak down to a 45x to 50x forward multiple. Applying that to a stabilized forward earnings power of $24 per share gives us our floor. This translates to a 30 to 35% pullback. It sounds pretty steep, I know, but structurally, wiping out that speculative retail leg brings SanDisk right back to a very healthy $1,100 to $1,200 institutional accumulation zone, essentially turning old resistance into new support.
Section 4. Refilling the void.
Let's move to the timeline and see how this builds, assuming underlying operational demand for these chips remains incredibly strong through the second half of the year. The landscape shifts dramatically once the IPO clears. Right now, in the pre-IPO phase, asset managers are accumulating cash, which is causing ghost selling pressure. Then on June 12th, boom, we hit the listing shock. That's the peak liquidity drain, where volatility spikes as tens of billions of dollars are officially locked up in SpaceX. But then, as we move into the late year, we start refilling the void. Non-space-focused funds step in to absorb the forced selling. The underlying cash generation of Micron and SanDisk hasn't changed at all. Historically, a drawdown caused purely by an IPO liquidity siphon is a high-conviction buying opportunity.
And finally, Section 5. Year-end peak targets. This is where things get really exciting. Think about it. What happens when institutional money managers, who were forced to raise cash in June, return their attention to the massive, undeniable earnings growth of the memory upcycle by the end of the year? Now, what's really interesting about this slide is the sheer scale of the potential rebound. Look at this journey. You have the June liquidity floor representing the mathematical pain point, and right next to it, the massive December peak potentials fueled by core business catalysts that, frankly, never actually went away. Let's break down the base case year-end math for each.
From Micron, we see that drop to the $680 to $740 floor in June, but by December, the base case year-end target explodes to $1,400 to $1,500. Why? Because Micron has monopolistic pricing power in HBM3E memory. Their production is entirely pre-sold through the calendar year. So as forward-looking EPS steps up toward the $32 to $35 range, that compressed multiple will aggressively re-rate back to a structural growth multiple of 42x to 44x. Combine that with institutional managers buying heavily in late November for end-of-year window dressing, and you get a massive extension rally.
And then there's SanDisk. Oh man, from that $1,100 to $1,200 June floor, SanDisk has the potential for an explosive bounce to a year-end peak of $2,300 to $2,500. This is underpinned by the fact that SanDisk isn't just relying on spot market pricing. They have locked down over $42 billion in 5-year structural corporate supply contracts. Wall Street consensus is mapping an explosive EPS ramp toward a $48 to $52 baseline. If you apply a 48x multiplier to a $50 earnings power, you hit Barclays' official $2,300 price target dead center. It is just a massive snapback.
So I want to leave you with this provocative thought. Are you ready to trade the cycle? We are looking at a textbook volatility spike play in the first 2 weeks of June. Implied volatility on tech options will skyrocket as books are settled for the IPO. Now, the market will definitely look scary, but remember the thesis here. The underlying cash generation of these semiconductor giants hasn't changed. It is purely a temporary shortage of investment capital. Understanding this structural math is exactly how you capitalize on cycle transitions.
Thank you so much for joining me for this explainer. If you found this breakdown of the SpaceX liquidity black hole valuable, please make sure to like this explainer and subscribe to the Noob Selling Options channel right now. We are going to be tracking exactly how this thesis plays out through June and all the way to December, and there is no way you'll want to miss our next update. Stay focused, trust the math, and I will see you guys next time.